The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The jitters in the U.S. equity markets continue for yet another day. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Alex Steele. Man, the headline level, forget it. But banks?
Oh, my gosh.
This is brutal. Yeah, exactly. Well said. And this chart kind of shows exactly what Romaine was just talking about. Okay, the headline level, sure, S&P is up 0.3%, but beneath the hood, it's really ugly out there if you're a bank stock. And if you're oil stocks, you can see kind of the rush to safety when it comes to the bond market. 3-year auction went well. And also the move into the dollar. So those safety trades remain holding firm on a day like today.
Yeah, a day like today where the markets really are on edge. Right now, you have at least 2 of the biggest banks in the world telling investors to really slow their roll on earnings expectations. Goldman CEO David Solomon saying third quarter trading revenue could fall 10%. And JP Morgan President Dan Pinto telling analysts they are way too optimistic in projecting next year's expenses and net interest income. JP Morgan down the most since 2020, the biggest point drag today on the Russell 1000. Meanwhile, the biggest percent decliner in that index is Ally Financial, also down the most since 2020 after the automotive lender's CFO highlighted intensifying credit deterioration. The commentary from finance chiefs comes amid a plunge in oil prices. Brent futures below $70 a barrel for the first time since 2021. As downbeat economic commentary from the U.S. all the way to China stirs up fears about consumer demand. And if that's not enough for investors to chew on, they are now being forced to finally confront political risk head on. 55 days until that big U.S. presidential election, 6 hours until the first and likely only debate between candidates Kamala Harris and Donald Trump, a 3-month measure of implied dollar volatility. Alex, right now, that's near the highest that we've seen going back to March of 2023.
Yep, and how do you hedge it? That's a great point. All right, let's get to the real story of the day, which was Romaine was talking about, what's happening to bank stocks. JP Morgan in particular now off by a whopping 11%. I had to look at that twice to make sure that was right. And I just want to point out the key levels that we're looking at here. It's the 50-day, 100-day, and 200-day moving average. We haven't seen this kind of fall since back from 2020, right? But you see how we've just sort of cratered through some key support levels and are really testing that 100-day moving average. And going back in the past year, we haven't convincingly broken down from that 100-day moving average. So if we break key support levels here, what kind of extra downside can you really see, Romaine?
Absolutely. We're kicking you off to the close here with Richard Saperstein, Chief Investment Officer over at Treasury Partners, joining us here in Studio 2 on another wild day in markets. And I know we're supposed to sort of look long term, look through the short term, but a lot's changed since I guess everyone got back to work here in September. And I think a lot of people are really kind of on edge as to, I guess, where we go next. I guess the question is, what's really going to drive this market? Is it politics? Is it still the Fed and the economy? What?
Well, it's going to be earnings because the beta Fed tightening is finally having an impact on weaker employment, lower manufacturing, and that's confronting the elevated expectations for earnings. So as statistics come out that are showing weakness, investors are trying to find the location of, are we going to end with soft landing, hard landing? And that's really the challenge right now for the market.
I know that there's been a lot of talk about the potential drop in rates that we're going to get, assuming that the Fed makes good on what the market has already priced in. Once we start to see that decline in Fed rates and we see the effect on the Treasury market and the fixed income space here, does that create a buying opportunity, or has the buying opportunity, should that have come, I guess, before the Fed actually moves?
Well, there have been several buying opportunities. Last year, we added a lot of municipal bonds at 4.5% yields. Rates have dropped 100 basis points. Those bonds are now at 3.70 yields. Investors still should be adding municipals right here. Basically, if you have the drive like we have, which is the return of capital is more important than the return on capital, you want to have bonds in a slowing economy. So investors should be looking at their allocations and determining if they have adequate protection against that uncertainty of where the economy is going to end up in either a recession or a soft landing.
What we've seen over the last month or well, a few months actually, is financials, funnily enough, and utilities really outperform. You get some cyclical and you get some defensive. Do you expect that to continue?
Well, we really like the utilities because there's a shortage of any energy production, not energy in the oil sense, but electrification power in the country as a result of the build out of data centers. If you look at the migration within the country, moving to Florida, moving to Texas, there's a real shortage there, and there are utilities to own in those states that have a long secular opportunity to build out power production and take advantage of the immigration into those states, as well as data center growth.
So that's one part of it. Then what do you do with the likes of, say, financials and some of the other cyclicals like industrials or energy right now?
So look, the financials, you'll hear from Mike, and you'll get the bottom line on that. But we like the sector, and this probably provides an opportunity to add to them. But we still are overweight technology. We think in the long run, it's a tremendous opportunity. As an example, Google's operating cash flow has grown 93% in the last 5 years. Stock's only up 99%. So you're buying on a cash flow multiple similar to it was 5 years ago. And it's similar with some of the other big cap tech names.
How much does that spread out beyond big cap? Because when people are looking at these valuations, obviously some are looking at the more traditional metrics, which are probably not relevant to some of those stocks. But once you get past those big cash flow generators here, does that cash flow multiple, is that still the right metric to look at?
We focus on the cash flow, which is why we own oil and the large cap tech, but we're not buyers of the small caps, the mid caps, international or emerging markets. We'd rather stick focused on the U.S. markets, larger cap, and there's a lot of opportunities in the market in different sectors, like technology. We think oil is very cheap, especially if you think about the world being a dangerous place, and at any point a flash could occur. So they're attractive at this point.
So what do you make of the moves, the recent moves that we've seen in oil? I mean, we talk about Brent dropping back below 70, WTI down. All the forecasts seem to be pointing to slightly tamped down demand, but I guess this might be more of a supply issue as well. Where does that leave oil going forward?
Well, I think the equities right now are trading with operating cash flows of anywhere from 15 to 25%. And you take out all the expenses that they need after that, and you're buying these companies at 10 to 12, 14% free cash flows. What they're doing is they're going to buy back stock, and they're going to pay dividends. Plus, you have a protection against a bad world that we live in.
But can they buy back as much stock as we might think if oil is at 50?
Not at 50.
Okay.
But many of them, like look at the Canadian producers. There's low extraction costs, and they're still going to be profitable and positive cash flow, even down to 50.
Did you just make a call on oil?
No, I'm just saying.
I think that was a what if.
Yeah, it's a what if. I'm teasing her.
If I knew that, I wouldn't be sitting here, man.
All right, 66 on WTI, 69 on Brent crude. Richard Saperstein, Chief Investment Officer over at Treasury Partners, joining us today to help kick us off to the close, a busy day, with a closer look at some of the big movers, including Ulta Beauty. B. Riley initiating coverage on that stock, suggesting it might be time for a market makeover. The analyst behind that call, up ahead. All
right, plus, it wouldn't be vodka made by Aquaman if it wasn't made with the best water. Actor Jason Momoa joins us to talk about Meili, which is apparently his new liquor brand that focuses on quality ingredients down to the water it's distilled with.
Looking forward to that conversation, as well as a conversation about that big CPI report on tap for tomorrow morning. We're going to set you up for what investors are expecting to see out of the data. All that and more coming up in just a bit. Stick with us. This is The Close on Bloomberg.
The analyst consensus is a drop in NII of 1.5 billion, from 91.5 to 90. That is not very reasonable, because the rate expectations is lower by 250 basis points. So I think that number will be lower.
That was JP Morgan President and COO Daniel Pinto speaking at Barclays' 22nd Annual Global Financial Services Conference, warning that analysts are too optimistic about next year's net interest income. Then just now, Bank of America's Brian Moynihan saying he also expects quarterly results for investment banking to come in lower than expectations. Want to bring in the man himself, Mike Mayo, Managing Director and a head of U.S. large cap bank at Wells Fargo Securities. Couldn't think of a better person to talk to on this, because the dramatic slide in JP Morgan is quite tremendous. I mean, down 5%. I haven't seen this level in 4 years. Is this an overreaction here, Mike?
Well, garbage in, garbage out. And look at the forecast for rate reductions. Last fourth quarter, everyone forecasted 6 rate reductions, and then they were off the table. And now we're looking at 8 reductions over a period of several quarters. So, yeah, if there's going to be a lot of rate reductions, then that can take an incremental toll on JP Morgan's traditional spread revenues.
Well, sure, but like everyone knows that. Everyone can look at their models. But come on, down 5% in one day just because the COO said that?
You have a very hypersensitive market to anything related to the 3 R's, rates, recession, and regulation. And all 3 R's are front and center right now. So you could see the stock and the group swing back very quickly just based on news about CPI tomorrow, Fed cuts, changes in regulation, which are still coming out. So there's a lot of moving parts here.
But this is also kind of that slow-moving train. And to Alex's point, too, I mean, we've known for quite some time that the rate hiking cycle had ended, and it was just a matter of time before we got to the easing cycle. And I do kind of wonder why we didn't see the banks prepare a little bit better for it, or was there nothing to prepare for?
Well, JP Morgan has managed interest rates about as well as any large bank. I mean, their net interest income, which they're saying is too high for next year, that's just based on consensus, has grown tremendously. They're among the best in class in terms of their management of interest rates. So maybe another story here is that so much of that higher traditional lending revenues are likely to remain. It's just, the stock market is based on expectations, and these are tweaks around the edges for what's a best-in-class global bank, given their multi-product, multi-distribution, multi-geographic approach that's gained market share in all key lines of business.
You mentioned the 3 R's. One of those is regulation. And it does look like the banks are going to get a bit of a reprieve when it comes to capital requirements based on Bloomberg reporting and as well as commentary by Michael Barr. We're looking at basically about maybe a 9% increase. I think originally they were looking at maybe a 19 to 20% increase. So obviously these rules aren't in place yet. But if that does end up being the magic number here, I would think that would be something to celebrate.
Actually, I think we, as collectively and myself, we're thinking it might be cut in half the last several months. So going from a 19% increase to a 9% increase was kind of expectations, and I think expectations were maybe even for less than that. I was looking for maybe 5 to 7%. So
really,
9%.
So that disappointed, that 9%.
Well, the devil's in the details. It's far from being finalized. But let's just pull the lens back on the banking industry for a second, whether it relates to JP Morgan or the capital rules. Here's a gold medal. And you know who I give this gold medal to?
You're going to tell us.
I give it to the banking industry for resiliency. I also give it to the regulators from a decade ago for making sure that banks would be in a better position to not have a repeat of the global financial crisis. And look at what banks did through the pandemic. Operationally, they were strong. Through that mini regional bank crisis last year, the largest banks were strong. The Fed stress test this year, I mean, that's tougher than the global financial crisis itself. And once you run those models, banks had a lot of extra capital. And look at the bond spreads in the $7 trillion investment grade bond market. The largest banks are pretty tight, a lot tighter than, say, regional banks. So the U.S. bank resiliency, I think, is underappreciated. So when I look at regulation, I say mission accomplished, job well done. I think there's room to always ensure that banks are resilient, but also while making sure you do it in an efficient way. I mean, look at JP Morgan's release, 80,000 pages on the Fed stress test, 80,000 pages on the living will. I think you can have resilient banks and with more efficiency.
And I'm sure you read every page of such things. So can you rate the banks now? Like, which is the one you like the best? Which has the triple R in thumbs up?
Well, and Citigroup's been our number one pick. It hasn't worked as well here recently, and it goes in fits and starts. When I say the stock hasn't performed well, but they're still reiterated their guide for this year. If they get their guide for this year, revenues far outpacing expenses, and then next year is anywhere close, and if they get anywhere in the ballpark to their return targets over the next 2 years, I still think Citigroup stock can double over the next 2.5 years. So I don't have a short-term catalyst, and behind that is Bank America. And they had a decent presentation today, and Warren Buffett's been selling every day. I read the Bloomberg articles, and it's like, here we go again. But I think they're poised to finally have that inflection point. So while JP Morgan's talking down their net interest income, Bank of America is saying they are at what could be a multi-year inflection point for that growth.
Yeah, I thought it was interesting how their presentation was maybe a little bit more positive than what we had heard out of Pinto and Solomon here. I just have to ask you here, that is your actual gold medal, right?
Oh, you have to ask.
So you competed in this USAPL event, and what was your total? Just
I got 1,000.
1,000.
So that's
okay.
squat, bench, and deadlift. So
that's pounds for our
not kilograms.
For the rest of the world, that's in kilograms. So it's about 500 kilograms.
And this is for my special masters category. So
all right.
it's kind of like recommending Citigroup, and they're in a class of their own. You don't have to do that well to make a lot of money.
All right. Well, congratulations, Mike. You got to leave it there. Mike Mayo, managing director and head of U.S. Large Cap Bank over at Wells Fargo Securities here. Kind of interesting, Alex. We did, of course, get some of those that commentary out of Moynihan, out of Solomon, out of Pinto here, and of course that is going to be the backdrop. Believe it or not, once we start earnings season in about a month's time.
Yeah.
Here.
Well, also, did you see about this salary increase here from
No.
Bank of America? Yep, they're going to increase its minimum hourly wage to $24 next month, taking the next step towards a goal of paying $25 by 2025, and that's set around 7 years ago. So look at that. There you go.
Yeah, absolutely. And this is well, I don't know. Maybe the Fed's looking at this and weeping right now, but that's.
But to be fair, they said it a while ago, so it probably isn't due to the cyclical to inflationary pressures from the pandemic. But you never know.
All right. When we come back after the break here, we're going to pivot, take a closer look at the consumer sector. Alex always says invest in your face, but one analyst says maybe we're not investing enough, and there might be a reason why. We're going to talk to the analyst behind one of our big top calls of the day. This is The Close on Bloomberg. All right, let's get a view from the sell side. Top calls, a look at the big movers that are on the back of analyst recommendations. And we start off today with Oracle. JMP Securities upgrading the software company to market perform after last night's better than expected first quarter report. The analyst praising Oracle's accelerating revenue growth, saying it has successfully evolved into a leading strategic cloud platform services provider. The shares having a phenomenal day, up 11% to a record high. Next up, DraftKings upgraded to neutral from underperform over at BNP Paribas. Exane, the analyst, saying he's encouraged by the improving near-term outlook and expects the online sports betting company's investments to shore up profitability in the coming years. Those shares moving higher on the day. And finally, let's take a look at Vivid Seats. Benchmark cutting its $15 price target all the way down to $10 a share. Keeps a buy rating, but notes it's been a challenging year for the ticketing platform amid uncertainty over the health of the consumer and tough comps in 2024 from the 2023 boost from those Taylor Swift and Beyonce tours. He doesn't see the current quarter providing any relief anytime soon. Those shares having one of their worst days of the year, down about 15% on triple the recent volume. And those are some of our top calls. We do want to stay in the sell side space and go from Taylor Swift and Beyonce to the beauty industry. Riley Securities starting coverage of the sector, rating e.l.f. Beauty and Honest Beauty buy, Estee Lauder neutral, and giving a sell rating for Ulta Beauty. Pleased to say that the analyst behind that call, Anna Glaessgen, joining us right now, senior research analyst over at B. Riley. And let's start off with Ulta, because that was the call here that really jumped out at me. A sell rating. I mean, Ulta has kind of been the darling out there. Everyone says, look, when times are good, we buy beauty products. When times are bad, we still buy beauty products. What's giving you pause here, Anna?
Yeah, of course. And I think that's, a key part of the thesis. People are used to Ulta being a really strong grower. It's clear from a top line CAGR of 15% that this has been a really strong story. But over the past few quarters, you've seen incremental pressure emerge from competition. You've seen a massive rollout with Kohl's and Sephora, and you're also seeing category deceleration. What we know about consumer companies is that it's really hard to fight both of those tides at the same time. And so we've seen comps actually inflect negatively in the most recent quarter, with estimates expecting further comp declines through the back half as the company continues to grapple with these challenges. We've seen market share declines in prestige makeup as they struggle with both of the category deceleration and competitive encroachment. And so we think there could be incremental pressure as we think about 2025.
So let me I just want to make one thing clear, Anna. So is this more of an issue of sort of broader softness in the sector, or more some of those customers that would have gone to Ulta, I guess, just finding a better place to go?
I would say, first, as far as softness, you are seeing meaningful deceleration, but you are still seeing growth overall in the category. Beauty responded out of COVID a lot stronger than I think most people thought, especially prestige growing in the double digits. And so you're seeing a natural glide path down toward normalization in the category. So I would say overall, the market share pressure suggests to us that the bigger issue is competition. But of course, you can't look at either of those, in a vacuum. They work hand in hand.
No, it's true. As I scroll on Ulta Beauty products and Romain's laughing at me, it looks a lot like other places that I frequent, like the Sephora app, etc. So how can Ulta stand out?
Yeah, I think that's part of the thesis here. Ulta's strategy is summarized as all things beauty, all in one place. And especially for things like color cosmetics, there is a natural path toward, or a natural part of the purchase journey is wanting to be in store, making sure your foundation matches, making sure you like how the product performs. And so when you have rising distribution and rising access for consumers to experience that product in store, that historical competitive moat might face some structural challenges. And so that's part of our what we're contemplating here with our rating.
Anna, on a macro sense, if the Fed lowers rates and we sort of find a bottom in any kind of weakness in the economy and the labor market sort of stabilizes, does Ulta get a boost on that, or it's not that simple?
I mean, I think it's natural for consumer discretionary stocks to see a boost if we do see a lowered rate environment. However, I don't think most end users are, consumers are thinking, oh, rates are cut, I'm going to buy more lipstick. I would instead, if you're trying to play a lower rate, play for more durable type categories.
Yeah, but I might be like, I'm going to buy that highlighter that I just found. Maybe I'll do that instead of the contour brush. Maybe that I will do.
Exactly.
All right, Anna, thanks a lot. Really appreciate it. Anna Glaessgen over at Riley Securities. We really appreciate it. Yeah,
I just went into Sephora today, actually.
You did?
Which, we have a Sephora right near Bloomberg World headquarters here. I got some facial cleanser, I can wash all this makeup off my face.
Are you investing in your face?
I do invest in my face, and I got something for my wife. She wanted these under eye things.
And did you have to wait online forever? And was it
No, I bought it online, and you pick up in the store. I was in and out in 5 minutes or less.
But you didn't browse. Nice. You weren't interested in browsing.
I don't do that.
Because the whole thing with buy online, pick up in the store is you then browse a little bit.
No, I don't browse.
All right, I'll work on it.
Sorry.
All right. Well,
if they put a coffee shop or something in there, maybe I'd stick around, get a muffin or
No,
something.
you won't. You don't drink coffee. All right. Tech is outperforming today, and that's a relative story. But it's really about the chips that have been hit really hard. Definitely down like 20% since their peak. Stacey Raskin over at Bernstein Research will be joining us next. This is The Close on Bloomberg.
All right, welcome back to The Close. Taking a closer eye on shares of Ally Financial, having their worst percentage drop going back to March of 2020. The auto lender actually warning that it's seen delinquencies up about 20 basis points compared to their expectations. That warning coming out of that big Barclays conference where we've been getting a lot of commentary out of the big finance CEOs and CFOs. Abigail Doolittle joining us right now to break it all down. This is a pretty dramatic move here. I guess I get it, right? I mean, I guess people are a little skittish that maybe the consumer really is on the back foot. What's going on?
I don't entirely get it. I mean, it's a huge move, down 20% at the lows, almost the worst days.
If you don't get it and I don't get it, then what's
Alex,
going on?
What?
Alex isn't listening.
I mean, it really is an outsized drop for a 20 BIP revision in auto loan write-off since August. I think what happened, based on what I've been told, is the CFO, Russ Hutchinson, he gave a really pessimistic start. It was the tone. He, in fact, asked the first question. He basically said something along the lines, I know you all want to ask this question, but how bad are the charge-offs? And then he went into the 20 bips. bips. So I think he set the stage
that's
there.
one approach.
Yeah, that's one approach. It's strange. I mean, he's from Goldman Sachs. You would think that he's just very well bred in terms of how to communicate things.
Yeah.
That just doesn't seem like the right way to do it for such a small piece. But I think the bigger piece behind this is that auto charge-offs for this company had been going up for 34 quarters in a row. 2Q was seen as the peak, and instead they're saying not only is the third quarter bad, but there's even more pressure ahead. They refuse to give like actual guidance for the full year. So I think that that's like this idea that it could be much worse. Plus, when I think about Ally, I think about the GFC. So when you start having a CFO talking about the fact that things are worse than expected and that the pressure is much stronger, I think that people are a little bit nervous.
I wonder if this was also just kitchen sinking it. I was talking to Allison Williams of Bloomberg Intelligence. I was asking her about JP Morgan specifically. She's like, I don't know why it's down 5%. Like, that seems a little bit of an overreaction. I would assume the same is extrapolated for Ally Financial. So I wonder if we're just like, get all the bad news out. That's what we're looking at, and then reset.
I don't know. JP Morgan, I get. I mean, you have the president of the company saying that net interest income is too high for next year. I mean, next year is many months away. What are they seeing that they're lowering it at this point, basically setting that bar lower? So that I get. This seems a little bit extreme, but it's interesting what you're saying about the kitchen sink, only from the standpoint that the CEO there, Michael Rhodes, relatively new. He came from Discover. He's known as doing things lightning fast. And when he first took over at Discover, he lowered the guidance there. So some are speculating that maybe this is their way of lowering guidance without actually doing it.
Have you been listening to all the commentary out of this? I mean, I'm surprised at how pessimistic a lot of it is. I mean, with maybe the exception of Brian Moynihan at Bank of America, who seemed to take a little bit more upbeat tone. But, it gets to the question, I mean, if this is kitchen sinking or just simply just trying to manage expectations in a way, maybe things aren't going to be awful, but like I said, set the bar low and then you beat, and you can say, okay, great, here
That's
you go.
a great question, because it's interesting just in terms of the consumer. When we think about it from the retail perspective, there's all these mixed signals with different retailers where consumers are strong. They're not. Credit card delinquencies, the serious credit card delinquencies are going higher. Some credit card delinquencies for the major companies are going lower. But what I'm trying to say here is 66% of GDP, the consumer, it sounds as though there's maybe some weakness here. It's not quite as firm. Just how bad it is, we don't know. But when you start to hear that credit, the lifeblood of the American economy, is maybe, in watch, that's an issue.
True. Ally Financial now sort of also erasing all the gains for the year. At one point, it was up over 74%.
Wow.
So, Abigail, thanks a lot. Really appreciate it. Bloomberg's Abigail Doolittle joining us there. That's an ugly stat.
And I was going to say, I was just looking at the schedule of that Barclays conference. We do get American Express executives speaking tomorrow here, so that could be interesting as well.
But that's for the higher affluent.
Well, that's what I mean. That's what I'm curious to see what they say.
They'll do really well.
Well, if they're pessimistic, then maybe we're in trouble.
Right. Or they're just more an indication of that bifurcated K-shaped economy. All right, coming up, Ann Sonders of Charles Schwab joins us to kick us into the closing bell. We're 15 minutes away on this Tuesday. This is The Close on Bloomberg.
Fed tightening is finally having an impact on weaker employment, lower manufacturing, and that's confronting the elevated expectations for earnings. So as statistics come out that are showing weakness, investors are trying to find the location of, are we going to end with soft landing, hard landing? And that's really the challenge right now for the market.
Richard Saperstein over at Treasury Partners helping us kick us off to the close just about 50 minutes ago, looking at yields lower. A mixed day for stocks here, Alex, as we head towards a couple of big catalysts. We have a presidential debate tomorrow, or tonight. Got a CPI report tomorrow and a bunch of other things as well.
It's interesting if you look between the composite of the S&P. Overall, we're not really doing that much, but energy and financials are just getting hit so hard, and you can't really make that up for, say, real estate still up by 1.6%, consumer discretionary up by 1.3%, but those cyclicals, tough.
And you saw the big move, of course, the drop that we saw in oil. I know you cover this better than anybody, but I mean, is this now about demand or is this really about supply?
I honestly think it's neither. I mean, I think at this point it has to be sentiment. You look at the curve and it's still backwardated, so prices today are still more expensive than prices later, and that's usually a sign of a stronger market. So it just feels a little bit like a washout, and does this create even more selling? Yeah,
it raises a lot of questions here about where sentiment is in the market is overall, whether you're taking a closer look at what's going on in oil, whether you're looking at the dollar, bonds, or of course stocks as well. Ann Sonders is the chief investment strategist at Charles Schwab. She joins us now as we count you down with just about 8.5 minutes until those closing bells. Where is sentiment right now, Ann? Because I'm not sure if it's good, bad, or just non-existent.
I would say it's a bit mixed. So I think of sentiment indicators, particularly investor sentiment indicators, leaving the consumer aside, as falling in one of two buckets. There's attitudinal measures of sentiment, so things like AAII, which is just survey-based, or investors' intelligence. And then you have behavioral measures of sentiment, whether it's fund flows or the put-call ratio and other metrics. So if you look at the collection of them, the attitudinal measures, which had been swinging pretty wildly with every up and down in the market, are kind of stuck in a pretty optimistic zone, which is surprising to me. I would have thought you'd ease some of that complacency, some of that froth, given some of the weakness that we've seen in the market since the mid-July low, but that's not the case. That said, we have seen fund flows kick back into the negative side of the ledger, at least in some categories. A couple weeks ago, you had big outflows out of U.S. large caps. Last week, it was big outflows out of consumer cyclical kind of areas. So on the behavioral side, a little bit of concern creeping in, but it's certainly not universal.
When you look at sort of the potential for where this market goes, there's been a lot of talk of, yes, we are going to maybe see a pullback here, but you have strategists over at Goldman and a few other places saying, look, we're not going into a bear market. This is just kind of a healthy reevaluation of valuations, if you will.
Well, keep in mind that under the surface, we've had a bear market, so or close to it in the case of the S&P. So the S&P on a year-to-date basis at the index level has had an 8% maximum drawdown. So that didn't hit correction territory, but that's at the index level. The average member maximum drawdown is negative 19%. Now, for the NASDAQ, it's even more extreme. So the NASDAQ at the index level has had a correction, a 13% maximum drawdown. But the average member maximum drawdown in the NASDAQ is negative 44%. That's a heck of a lot of weakness and churn and rotation and turmoil under the surface. It just got masked and has been masked by the dominance of the mega caps in these cap-weighted indexes. So there has been a lot more going on and more to the story that's told under the surface of the indexes, and that's where you've seen some of this weakness.
Nevertheless, non-Mag 7 firms had more than double growth expectations for the last quarter, with 3 of 11 S&P sectors actually showing growth, like industrials, real estate, and staples.
Yep.
So what is that? How should you then be reallocating your money?
Well, I think that helps to explain why we've lost some of that leadership profile in the Magnificent Seven. So a couple of quarters ago, you had an extreme spread in terms of Magnificent Seven earnings to the tune of about 60% year over year relative to flattish, if not actually marginally down for the rest of the index. That is starting to converge. And by the end of this year, you will be down in the high teens for the Magnificent Seven in terms of earnings, and you'll be up to the low to mid teens in the case of the rest of the market. So I think that is part of the reason why you saw this shift in leadership away from just the Magnificent Seven. And then you add to it Fed policy shifting into easing mode, most likely, and those interest-sensitive areas like real estate, which you touched on. And I think these leadership shifts and the lack of just consistent dominance by the Mag 7, I think that has legs. Not every day, every week. Mm-hmm. Today's a day where tech is doing well, but I think the broadening out probably has some sustainability.
And is that broadening into the cyclicals like materials and energy, or is it broadening into like the financials and healthcare?
Well, it was into the classic interest sensitives going back to the mid-July highs in the overall index. So you saw the best breadth profiles over the last several weeks in financials, in utilities, in REITs. But obviously, in a sector like energy, you're going to be at the mercy of oil prices. WTI is down just over the last couple of months from 82 to 66. Broad commodity complex has been under pressure as well. I know you were talking about it before we came on here as to whether is it the demand story, the supply story, maybe a positioning story, a little bit of a sentiment story. Nonetheless, that type of cyclical sector in energy is going to be driven by the underlying prices of the commodity associated with it. So I still think the interest sensitives can do well, but then you get these one-off stories like Ally Financial today putting pressure on the financials, and we're going to live with that.
Yeah, I'm curious, does anything change based on what we think we're going to hear from the Fed in 1 week's time here? I mean, it's sort of all anticipated, all priced in. Does that provide any sort of shift, though, in how people are going to view conditions?
Well, obviously, we've jumped around in terms of probabilities around 50 or 25 basis points with every incoming data release. Right now, you're at about a 2/3 probability of 25, 1/3 probability of 50, but we've got a CPI and PPI report coming up here. Our view is they're most likely to move 25 basis points. And I would say be careful what you wish for to folks out there wishing that the Fed is going to start with 50, do another 50, be aggressive. That, based on history anyway, a more aggressive Fed once they start a cutting cycle, if you look at whether it's the 6 months following the first cut or 12 months following the first cut, the average maximum drawdown is about twice as big when the Fed is moving aggressively versus when they're moving more methodically and more slowly. So not only do we think 25, it's probably the better backdrop for the equity market.
All right, Liz Ann, always great to talk to you. Liz Ann Sonders, Chief Investment Strategist at Charles Schwab, helping us count you down to those closing bells. We're just about there here. A mixed day here in markets with the NASDAQ, your outperformer on the day, up about 1%. The S&P, which had been in the red, now posting up for about 0.4% gain. A full breakdown of all the market action coming up right now, right here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Alex Steele, taking you to the closing bell. A global simulcast. It starts right now. Scarlett Fu in the television studio. Tim Stenovic in the radio booth. Katie Greifeld along his side, filling in today for Carol Masser. Welcome in to all of our audiences from all of our platforms, including our partnership with YouTube. Tim Stenovic, a mixed day here in markets. What do you make of it?
I'm really watching what's going on with the banks. I know Katie's going to be talking about some of those at length, but the KBW Bank Index down 1.9% right now. We're hearing from a lot of banks that are at the Barclays conference. They do this each year, and it seems like they're really tempering expectations or managing expectations about what's to come when we start to hear from them in the most recent quarter in, just about a month.
Yeah, it'll be interesting to see what we actually hear from them and whether they're under-promising now to over-deliver. We'll get into that as well. It's interesting that we have so many risk events loaded up between now and 8:30 a.m. tomorrow morning. The debate, of course, inflation numbers, things are getting excited again, even though, you think about the markets today, not too much action.
Yeah, not to mention NVIDIA's Jensen Huang speaking with Goldman Sachs' David Solomon tomorrow, and I'm sure top of mind for a lot of people is what's going on with Blackwell and the manufacturing delays that we've seen with that chip.
I don't know. I think you guys are overselling it. I think you're going to get the debate, sure, but then with CPI tomorrow at 8:30, is that really going to resolve the debate of 25 or 50 that will give direction to the markets? Come on.
All right. Well, we're going to find out here. And I guess investors, and maybe that's part of the problem is it's kind of like investors just have so much that they could focus on. And the question is, what do you pick and choose? A mixed day here on Wall Street as we get the closing numbers here in New York. The Dow Jones Industrial Average lower by more than 80 points, roughly about 0.2%. We wait for these numbers to settle, but it looks like it's going to be a down day for that index. The S&P 500, despite all the turmoil, despite all the hand-wringing, it's actually 2 straight days of gains, a 24% gain, 24-point gain on the day, up about 0.5%. The NASDAQ up about 0.8%. The Russell 2000 actually tried to get a bid here going into the close. It looks like it's going to finish in the green. We're going to call it unchanged. It's down less than 1 point on the day.
Well, taking a deeper look at the S&P 500, you had more stocks advance than decline. Not surprising, given that the index did move higher today. 263 stocks moving higher, 236 moving lower.
I was just counting, and the S&P 500 changed direction 6 times, at least 6 times today, although in the last 2.5 hours, it's been on a steady upward trajectory. And that's what you see in the sector performances as well. A lot of green there, led by REITs, led by consumer discretionary companies, and led by tech. All 3 of those groups up at least 1%. But the weak links are pretty weak. Energy stocks off by 1.9% as Brent crude falls below $70 a barrel. And financials, as you guys mentioned, losing 1% on the day.
All right, well, let's take a look at some of the
Tracy
stocks.
Alloway bought like a barrel of oil or something and kept it in her bathtub.
Yes, I do remember this.
That was
very cool.
Tracy Alloway.
Tracy Alloway, a bod lot. She bought like a small little barrel. It wasn't a full barrel, but she kept it in her bathtub.
Still counts.
Yeah.
Is that allowed in like apartment buildings?
I don't think so.
I feel like
The room's probably pretty small.
such a New York problem, right? No oil allowed. That's in the bylaws. Hey, let's take a look at what happened to some of the gainers today. Oracle higher by 11.4%. They actually hit a record shares after the company reported profit and booking that topped estimates. AI demand continues to boost its cloud computing business. Remember, Oracle has been focused on expanding that cloud infrastructure. They rent computer power. They compete with Amazon, Microsoft, Google. They've developed a reputation for success with Gen AI workloads. The company touted customers including Elon Musk's xAI. And speaking of Elon Musk, Tesla, another one of the gainers today. Shares finishing higher. This after Deutsche Bank resumed coverage of U.S. autos and auto tech sector. They named Tesla its top pick. They said the company is in a, quote, league of its own and represents our highest conviction secular leader, poised to reshape multiple industries across auto, energy, mobility, and robotics. Shares of Tesla higher by 4.6% today. I want to do a fun, sweet one to end the day. Tootsie Roll Industries.
Oh.
Yeah.
Okay.
TRUS.
Yeah, I always forget they're publicly traded.
Yeah, market cap.
Candy's gross.
Excuse me?
Sorry.
What?
Excuse me?
Tootsie Rolls are disgusting.
Nah, disagree.
Okay, I think the 69 boys disagree with you as well. So.
The stock, the best performer among its peers, finishing higher today by 3.2%. No fundamental news I could find. Shares flat.
Thank you for that. I love Tootsie Rolls.
But a fun one to end on.
What's the market
You don't
cap?
like chocolate.
It's like $2 billion.
It's fudge.
That's real chocolate?
Yeah.
No, that's the point. All right, now this all makes sense. Katie.
All right, it's my turn. Let's get to the bad news. Let's get to JP Morgan, of course. We all know the story there. We had President Daniel Pinto come out and say that analysts are being too optimistic in projecting next year's expenses and net interest income. Of course, he was one of, it feels like several banks, Goldman included, sort of tempering the outlook here. JP Morgan shares finishing about 5% lower on the day. At one point, it was 7.5%, which was one of its worst days since, I think, June 2020. So finishing off those levels, but still down about 5%. The next one we have to talk about, Hewlett Packard Enterprise, of course, HPE, shares falling quite significantly. It's a boring reason, of course. They said yesterday that they had commenced a convertible preferred stock offering. You can see that investors clearly not too psyched about that. Hewlett Packard shares really taking a dive there. And then I wanted to finish, of course, with Exxon. Scarlett was talking about how energy stocks were some of your worst performers today, and Exxon was no exception. You take a look at how shares finished up, down about 3.6%.
What's the difference between fudge and chocolate?
I couldn't tell you.
That is
No
a
idea.
great question. No,
Need a chocolate
is it
cheer
more
here.
condensed milk versus something else? Hang tight.
I know. Do yields,
All right.
and I'm going to Google this.
I'm going
while
to
you're
do
doing
That's a
that.
good
Yeah,
distinction.
sure.
All right, let's go to bonds for a second. You saw a bid pretty much all across the curve. You have two-year yield down by about 7 basis points. You had a 3-year auction that actually went pretty smoothly. The demand was pretty solid. And then tomorrow you get $39 billion worth of tenure, and then you get a 30-year later on in the week of $22 billion. So clearly that bond bull is still very much alive and well today. And
Fudge,
Yes.
according to Google, fudge is not the same as chocolate, but it can often contain chocolate. It's made from sugar, dairy, and flavorings, and is cooked cool.
Was this an
and
AI
smooth.
answer?
See, it's more similar to caramel. Yes, it's AI, so
Okay.
it's probably wrong.
This
But
is why I don't
nevertheless,
Checking on that.
nevertheless, that's what
Consider the source.
that's what the
I like
the little
flavorings.
internet
That's really
box. Yeah.
vague and specific, you know.
Flavorings. I love me some
Specific for
flavorings.
our purposes.
But I will
Yeah.
eat fudge, but I won't eat a Tootsie Roll. Just throwing that out there for a new distinction.
Learning a lot about all of us, mostly Alex. I don't like chocolate.
Are we still getting earnings?
Yeah.
We are still
Yeah, we
getting
are.
earnings. Have you ever been to
Wow.
a Dave and Buster's, Tim?
All right, yeah, ticker
Yeah.
PLAY. Earnings pulling up here
love that
on
ticker.
the Bloomberg terminal. Second quarter adjusted earnings per share beats estimates. Second quarter entertainment revenue coming in above estimates at $375.7 million. Second quarter adjusted earnings per share coming in way higher than estimates at $1.12. Dave and Buster's second quarter EPS also coming in above estimates. Shares bouncing around, but up 5.6, well, 7%. As we speak right now.
All right, let's get over to Petco. The ticker there is WOOF, of course. It's where the pet goes. Shares are moving higher right now because they reported net sales for the second quarter that meet expectations. Net sales coming in at $1.52 billion. The estimate was for $1.53 billion, but this is interesting. The adjusted loss per share in the second quarter came in at 2 cents. That is slightly better than what analysts had been looking for, about 2.3 cents. And they look forward there to the third quarter adjusted loss per share of 3 cents to 4 cents. 3.1 cents is what the estimate had been. So you add it all together and shares moving firmly higher right now.
All right, let's take a look at GameStop earnings. And, when we say earnings, we kind of quote marks around it. Adjusted EPS of 4 cents. I'm not sure what that compares with, but let's look at the revenue line. Second quarter hardware and accessories net sales missing the average analyst estimate. That was about $451 million, down 24% versus last year. Analysts were looking for $477 million, so that's a big miss. Net sales overall down about 31%. Software net sales also down about 48%. Within the revenue line, everything is down year on year.
Yeah, I was going to say, I was looking through the press release to see any color. There's no color. It's just numbers and bye-bye. There is no conference call today. And this goes on. Michael Pachter over at Wedbush said that this company continues to face a, quote, near insurmountable barrier to its planned return to growth. And clearly these numbers with those declines year on year aren't helping it any.
Yeah, well, planned return to growth. I mean, you have to put that in quotation marks because, what's the plan here? 31% drop in revenue, and even that collectible side, which was actually one of the few bright spots that they had in past quarters, being that down also 18% here. There's just negative signs in front of everything.
Yep.
What are you doing, Scarlett?
What am I doing?
Yeah. Looking at the difference between fudge and chocolate.
I'm just thinking, when was the last time I was in a GameStop? I go with my kids, but you just kind of look at it, the store shelves are really bare, and then you move on.
Yeah.
I don't know what they're set to do with this turnaround that has been years in the making that has yet to materialize.
Is there not another roaring kitty tweet that can say
to
this
Katie's
stock?
point in the chat, she does point out that the stock is up almost 34% year to date. Thank you so much, meme stocks.
Yeah, you're outperforming if you are in a single stock portfolio of just GameStop.
All right, that's got to do it for our cross-platform coverage of the market close on Bloomberg TV, radio, YouTube, and Bloomberg Originals. We're going to be back tomorrow, same time, same place. Katie and I are going back to radio, YouTube, and Originals. Alex is heading out. Scarlett and Romaine are staying there on TV. We'll see you guys tomorrow.
All right, our coverage continues right here on Bloomberg Television as we make a little bit of a pivot. We want to talk about natural resources, maybe, because the natural resources from the great state of Montana are being used to fill a so-called void in the vodka industry. Meili Vodka. It promises to lift your spirits with locally sourced high-quality grains and natural spring water. And if that's not enough to sell, one of its sustainable bottles of star power behind it might do that just as well. I'm happy to say that the co-founders of Meili Vodka join us right now here on the big program, Blaine Halvorson and the actor, Jason Momoa. Thanks for both of you gentlemen for joining us here today here. And of course, Jason, I'm going to start with the very obvious question here. Just tell me, what sets this vodka apart from all the others?
Why does this set apart from all the other vodkas?
Yeah.
I think the other vodkas don't taste good. I think we set out to make this vodka just because we wanted to treat it like a spirit instead of an ingredient. So it's been, that was kind of our goal. It's taken us quite a while of time to do that, but we found out that it was actually because of, it's the water we use. And, vodka is 60% water. Mm-hmm. We use a live water from Montana.
Well, give us a sense here too, Blaine, when we talk about how you sort of market this, and more importantly, I guess getting on shelves in what we know is a very crowded space. I mean, there are a lot of liquor brands, a lot of vodka brands specifically out there here. How do you get this in front of people in a way where they look to Meili Vodka rather than all the others?
Yeah, listen, when Jay and I started this thing, like I said, but we were not vodka guys. We were more in the whiskey and tequila things. We saw void in vodka. Just to us, vodka was really looked upon as an ingredient. So we've just sort of charged in creating something that was different and giving vodka an actual flavor profile and something smooth and treating it more, as Jason said, as an actual spirit rather than an ingredient. So, it's been a big piece. Obviously the vodka market is really kind of controlled in general by kind of the big four that have been around quite some time, and it just felt like it was a piece of the liquor industry that was ready for a change and needed something different.
Yeah, both of you have a history together, right? You started on this journey to create something 8 years ago, and it sounds like you kind of stumbled upon vodka as your collaborative, product here. But part of the origin story of Meili Vodka is that neither of you actually like vodka. I'm guessing that has changed now, but
we love vodka now. But
right.
No, that's the beautiful thing. Like this bottle, like what we set out to do, just the design quality of it, it ticks off everything that we love. So the sustainability aspect of it, we wanted something that tastes good. It's got a great story behind it, and to be able to drink this, and we take it to everybody. We ask them to drink it neat and drink it, warm, room temperature. And it tastes beautiful. And we went up for all the competitions, and we poured out. It's a blind taste test, and we won everything. So it's been I think one of the most decorated spirits in the world. We got 7 golds, 3 platinums, and 2 perfect scores. So we've been out for a year and a half, and it's just been wonderful actually to take it to people and show it to them, and at the price point where it's still anywhere from $20 to $24 for a bottle, and it's beautiful. And it tastes good. It's like we wanted to make that something that's affordable luxury,
Right.
And
we should point out that no 2 bottles are the same because each bottle is different. The manufacturing of the glass bottle is really a point of pride for you. Blaine, I'm curious, as you bring your vodka around and you have different people taste it, I'm wondering if you've gotten any kind of feedback from the big players in the industry, the Constellation brands, the Diageos, whether anyone's talked to you about the flavor profile that you have come up with for Meili Vodka.
I mean, listen, most people in America, I don't think actually even know what vodka tastes like. I mean, they're used to drinking it in a drink, and that was sort of our point. I mean, the fact that we go around and have people try it at room temperature and in its natural form. I mean, you can kind of tell a lot just by people's first sort of impression of when you're asking them to drink vodka warm. Most of them sort of turn their nose because they're the ones that have, they sort of know that in general, vodka tastes like rubbing alcohol. It's hot. It's got that burn, and it's why, it became something they covered up in drinks. We wanted to create a beautiful spirit that you didn't have to cover up, and then would give the bartenders and mixologists and the people in the industry actually something to actually build off of. Yeah. We single distill for that reason. We wanted to leave all the beautiful, the beautiful grains that we use, and most of all, what we call the unicorn, this unbelievable water.
Yeah. Well, talk about that, Blaine, because that was the part I was interested in. I mean, most of these vodkas, they're distilled several times, primarily to make it a neutral spirit, which, as you pointed out, because a lot of people use it as to mix in with something else, by only distilling this once. So you're leaving behind those grains, or at least a flavor from those grains. Why do you think other vodka companies, I guess, effectively are throwing that out, for lack of a better word?
Well, I think I think it's been mainly a marketing tool, because I don't think people necessarily understand, in general, the more you distill it, the only thing that's surviving distillation is the alcohol. And to me, it's why, we never liked it, because drinking alcohol in its natural form isn't very good. And listen, anybody who, this whole myth of vodka, of this, no smell, no taste, if that was the case, I mean, everyone has failed. I mean, anybody who's tried vodka naturally, there's nothing about it that doesn't have, heat in itself tastes like something. So we wanted to create something that was actually, like I said, more smooth. I mean, we age our vodka as well. Given it that time, similar to like a whiskey, also helps smooth it out. But that single distillation, because we're leaving this beautiful water in it as well, it's going to be smoother, because you're not cooking down, you're not getting rid of everything but the alcohol.
Right. Jason, let me ask you the final question here. What has surprised you most about the spirit industry? I know that you've been in the entertainment industry for a long time. You have other business interests, but as you move further into the spirit industry, what surprises you the most?
Well, and nothing at this point really surprised me as much as it was extremely challenging from the get-go. So, it took us 9 years to actually build this to where it's at. This wasn't an overnight thing, and no one came to us and were like, "Hey, would you be a part of this and that?" It's just been Blaine and I. So there's no partners, there's no Diageo, there's nothing. It was just us. So that whole time, they gave us, time to trial and error, test this out. We really, Blaine really was the genius behind. And obviously, I know a few things about water, but it's like it was all about these pure water sources. And so we traveled in that time with Expedition Studios. We brought back water from Antarctica. We brought back Everest. We brought back the Shackleton route from Greenland, and bringing back all these, the Northwest Passage, bringing back waters, mixing with our mash, finding out that people were like, "No, you're just going to distill it. It's going to go away," but it didn't. And each flavor profile was different. So when you use RO water, which most spirits are made out of, it doesn't taste good. If you have a really beautiful, one-of-a-kind water, which we do, it's our unicorn in Montana, and that water source is high. It's low in sodium, so it doesn't cover up the grains. And so I think the hardest part was the beginning, because it took a long time to get into it and like really perfect this, a place where we didn't know much about.
Sure.
But now it's like we know how to sell. I mean, we know how to sell. We know how to be intimate and be able to go to places and meet with people. And so now it's actually quite fun. I mean, I'm going to go on stage and play music with my band right now and share, drinks with thousands of people and really just experience what it's like and have a good time. So I think the marketing aspect of that is already past the hard part in the sense of now it's just getting it to people going like, hey, here's the thing. We love scotch, we love mezcal, whiskey, all that stuff. You can have tons of them, tons of different bourbons. You need one vodka. You really need one. And so take one of these bottles home, test it with your friends, blind taste test them, and just try it out. It's $20. You'll have a ball.
All right. Jason Momoa and Blaine Halvorson, spoken like true entrepreneurs there, the journey of, stumbles and starts before you kind of find your way. Co-founders of Meili Vodka. Thank you both so much.
Thank you very much. Thank you.
Yeah. It's kind of interesting, too. You got that little reference. He knows a lot about water here. We didn't ask him about, of course, his turn in Aquaman there. Obviously, a little bit of a link there. Of course, he's also going to be in a new movie. I don't know if you've seen this, but Minecraft, which I don't know if your kids play. This is huge in my household. They dropped a teaser. This movie is going to be released next year. Of course, it stars Jack Black as Steve, and there you can see, you just saw him there, Jason Momoa, and that nice, I don't know if that's a wig or his real hair there.
That doesn't look like Jason Momoa.
Yeah, well,
that might be part of the problem.
The part of the problem, this is getting a lot of traction on the internet right now as everyone's trying to figure out why this movie is what it is. But of course, this has been a long time making here, and of course, the founder of Minecraft, he's been negotiating with Warner Brothers for a long time on this, and we're going to finally get it in 2025.
Yeah, I'm not liking this Jason Momoa with bangs. Is that Jack Black?
That is Jack Black. He's the star of the movie.
Okay, I mean, when I think Minecraft, I think of a certain aesthetic, and this is not what I thought it was going to be. And I think that's what a lot of people on the internet are finding also.
Absolutely.
All right, coming up, meme stock mania. We're diving deeper into GameStop results. I didn't say earnings, Romaine. With Nathaniel Popper, he is author of The Trolls of Wall Street next. This is The Close on Bloomberg. We're keeping an eye on shares of GameStop right now, following its latest results in which net sales seems to have missed, whether you're looking at the hardware category or the software sales. Nonetheless, the stock slightly higher. Actually, it's kind of bouncing around right now. Little change at the moment. Nathaniel Popper is author of The Trolls of Wall Street, and he joins us now to dive deeper into meme stocks and the craze around GameStop. So, Nathaniel, we make a valiant effort to try to look at the earnings results and see what we can glean about this company, whether the second quarter net sales are down by double-digit percentages and what it means that hardware sales are down by quite a bit. Is there any point in looking at these results when, the press release itself has a boilerplate that's longer than the actual results? Why even publish results at this point that don't tell you very much about how the company is going to move forward?
Yeah, I think you're right that a company like this, this is the archetype of the meme stock, of course. And to some degree, the price of this stock has become disconnected from the fundamentals. And so to some degree, those fundamentals don't matter. But this is a company that over time, obviously this began in January 2021, really the frenzy around GameStop. And, it's down since then. And there's a reason for that. This business, investors are looking at, at revenue and at this supposed turnaround that everybody's been waiting for so long. Mm-hmm. So it's a push and pull between the trolls and the fundamental investors.
Right. And I joke because, of course, the company needs to publish results. It's a publicly traded company. That's part of the requirements. But you talk about the trolls and the fundamental investors. Roaring Kitty had styled himself as a fundamental investor, but we haven't actually heard that much from him when it comes to what he likes about the company fundamentally.
It's really... I think when Roaring Kitty returned in May of this year, it was, in some ways, a new character, a different character than the Roaring Kitty from 2020 and 2021. Back then, Roaring Kitty was in many ways, a value investor, as he put it in his screen name. And he was thinking about the fundamentals of this business, digging in deeply to the details of the earnings releases, of regulatory, every new regulatory filing that was coming out. And, when Roaring Kitty returned this year in May, it was a different, just meme-fueled character who was much less plugged in to the fundamentals of this business. And, in reality, what we've seen since May, in May and June, GameStop shot up when Roaring Kitty first returned again. Mm-hmm. But it seems like he has sort of backed out of the stock. Since then. I mean, he went up a bunch and then lost a bunch. Yeah. And it seems like he has moved on to other stocks, other interests.
One thing that was interesting, too, about your book, though, I mean, it kind of captures kind of the zeitgeist of the time. The idea that a lot of these retail traders were at home, so they had the flexibility to participate in this. You, of course, had, the whole Wall Street bets community, which just sort of found itself thrust into this. And, of course, the whole rivalry between the different moderators there here. It feels like that part of it is also dissipated. So maybe that's why, a new tweet or a new posting by Roaring Kitty doesn't get as much traction.
Yeah, I think that there's a lot going on here, but one part of that is that the sort of meme stock element of the retail investing crowd has definitely diminished over time. I think part of what's interesting, though, is that retail investors, the sort of interest in the markets broadly has not diminished over time. Mm. And I think it's to miss that sort of evolution into a new, more long-term kind of investor. I mean, meme stocks were the sort of gateway drug to the markets, I think, for a lot of investors. And actually, what you've seen recently during the big market gyrations around NVIDIA and AI stocks is that when stocks have gone down, retail investors have piled back in. And so you're seeing levels of retail interest in the markets that are basically where they were in January 2021 during this meme stock craze.
Yeah, they've piled back in, but maybe in different ways. Options, single stock ETFs, all of that. Nathaniel Popper, thank you so much. Author of The Trolls of Wall Street. A great look here at what's going on in the meme stock universe. We want to go now to our top three, where we focus on the people driving some of the day's most talked about stories. And first up is Selena Gomez. So the actress/singer's cosmetics company, Rare Beauty, it's now pausing its sale process, according to Axios. On paper, she's a billionaire based on the $2 billion valuation for a company, but maybe not doing so well finding a buyer.
All right, there. I'm taking a look at another guy, Ted Zanaristas. Of course, he is the co-founder of the fast food chain Cava, or I don't know if they call it a fast food chain, but of course it went public. And he's actually putting some of that money that he made to use here, an $8.6 million mansion in Washington, D.C., where he is based, a newly built mansion, we should point out here. I think the listing had something like 7 bedrooms. And there you have it. Looks like a cozy little place there in Upper Washington, D.C.
Yeah, 2 kitchens, an elevator, wine storage, sauna, exercise room, carriage house as well. All right, third up is Billy McFarland. The man behind the infamous Fyre Festival says that over 1,200 fans have applied for tickets to Fyre Fest 2. So he's moving forward with this thing. Tickets are going for as much as $1.1 million.
Yeah, well, I don't know who's going to buy that there, but there you have it, Fyre Festival 2 there. Yeah, I don't know. Apparently not. All right, we're going to be back in a moment here. Take a look back in history. We'll continue in a moment right here on Bloomberg. All right, let's look back in history to 74 years ago, this September, when the Insurance Company of North America began offering a first-of-its-kind homeowners policy that bundled all of the risks associated with owning a home into a single package policy. Now, remember at the time, then, back in 1950, a homeowner who wanted insurance for fire would take out a policy for just that, and a separate policy for theft, and a separate policy for accidents, et cetera, et cetera. INA figured it could package all of those together into a so-called multi-line policy that bundled all of the myriad risk for a house at a cost to the homeowner that was at least 20% less than the combined premiums on separate policies. That all-inclusive 5-year policy, which included protection for fire, theft, weather, explosion, riots, even aircraft and land vehicles, cost between $88 and $100, or roughly about $1,300 on an inflation-adjusted basis today. These new all-in-one policies, they were a hit with consumers who appreciated the cost savings. They were also a hit with insurance agents who found the contracts simpler to explain and sell. Businessweek magazine called the new insurance product at the time revolutionary, and it was. The new comprehensive policies would completely reshape the insurance industry in a way that ultimately reshaped both home building and mortgage banking, as the policies gave lenders more security that homeowners would be less likely to default in the event of a home catastrophe. That in turn made homes more affordable. That in turn increased home building, which increased the number of construction jobs and spurred greater economic activity, all tied to a simple idea that packaging things as one could be better than letting everything stand alone.
Kind of like the original bundle. And of course, when we talk about home ownership, there's a tie here to politics because Kamala Harris has made supporting the U.S. housing market one of her main issues here as she heads into the debate tonight against former President Trump. The two of them gearing up for their one and only scheduled debate at 9 p.m. Eastern in Philadelphia. They've agreed to a 90-minute event with no live audience, no opening statements, and microphones muted when it's during the other's turn to speak. David Gura is at the venue in Philadelphia and has more on this. So, David, heading into this, we know that both sides were rehearsing or preparing in their own specific ways for this upcoming debate. The interesting thing is there's nothing to draw on here because neither of them have met each other or talked to each other before.
Yeah, it'll be a very dramatic moment when they face each other on that stage. We'll all be watching to see what the body language is between them. But it does kind of complicate things. So you mentioned how they've been preparing in different ways. Vice President Harris has been in the western part of the state in Pittsburgh for the last few days, going over policy briefings, doing some mock debates. She had somebody playing the role of Donald Trump. She's looking at footage of what those debates were like between Hillary Clinton back in 2016 and Donald Trump, trying to get a sense of what that body language might be like and how might she act in response to it. Donald Trump taking a different approach to preparing for this debate. He has been on the road doing rallies and then having kind of policy conversations with some of his closest advisors, but not doing the kind of traditional debate preparation that we would have seen in past campaigns, Scarlett.
David, give us a sense here. I know you're kind of at a separate site where they kind of keep the media kind of a little bit further away from the Constitution Center, just a few blocks away from Independence Hall, down the street there. There's no audience here. You're just going to have the moderators, the ABC moderators there here. I know there's been a lot of discussion about the parameters of this debate and what the Harris campaign agreed to and what the Trump campaign appeared to. How is this going to feel different than what we saw with the Biden-Trump debate back in late June?
You know, fundamentally, the rules are very similar, if not identical. I just walked down up Market Street to where the debate's going to be, as close as I could get to it. It's pretty heavily fortified. And as you say, they're not allowing outside media in or an audience of any sort. We're here from a remove, obviously hundreds of reporters who are here to cover it. I think it's going to feel, in a lot of ways, atmospherically, like what we saw in Atlanta. But of course, we knew mere seconds, if not minutes into that debate, that something was not going the way that the president hoped that it would. It was an odd dynamic between the two candidates on stage, to say the least. We'll look for any kind of indications of how this might kind of play out over the course of tonight. But I think fundamentally the rules, the parameters of it are the same as we saw in Atlanta, and this was pretty hard fought over these last few weeks. There was a robust argument among both campaigns, particularly about muting those microphones, having one microphone muted when another candidate was answering a question. That is something that the Trump campaign really wanted to be in place, Romaine, but the Harris campaign did not. I mean, such a signal moment for her during her last really big debate against Mike Pence was when he kept interrupting her, and she was able to say a couple of times during the course of that debate, "I'm speaking." That was clipped, made viral, and I think the Harris campaign was hoping for the opportunity for another moment like that tonight, and we'll see if they get one.
Gotcha. Of course, there was a recent poll by the New York Times and Siena College which found, the race is pretty much neck and neck. Trump leading Harris by 48 to 47%. So it's basically a dead split here. In terms of what the poll also indicated, what are voters going to be listening for? What do they want to hear from Kamala Harris or President Trump, former President Trump?
So that poll that you're citing kind of confirmed what a lot of people, including on the campaigns, had expected about this, that it's neck and neck and it's going to be decided on a razor's edge. But if you look into those numbers, I think the thing that stands out to me is the fact that when you look at those who are polled who want to know more about a candidate or feel that they don't know enough about a candidate, more than a quarter say that about Vice President Harris. Donald Trump is a known quantity. The American electorate knows sort of what he stands for, what he believes in, and how he acts. I don't think the same thing is true if you look at those poll numbers for Vice President Harris. So if this is the only opportunity for these two candidates to meet on stage, and currently it is, it's the only debate on the calendar before Election Day, it is a hugely important moment for her to kind of answer some of the nervousness or questions that those voters may have, both about her background, what's important to her, what policies she prioritizes, and how she might approach being president if she's elected in November. So a crucial opportunity for her tonight.
All right, our very own David Gura on the ground there in Philadelphia. Bloomberg Television and radio will have special coverage of ABC's presidential debate between the two candidates. Our coverage starts at 8 p.m. Eastern. Of course, the debate itself kicks off at 9 p.m. there from National Constitution Center in Philadelphia. Meanwhile, back here in New York, we stick with politics and take a closer look here at maybe what CEOs have on their mind. Our next guest says geopolitics is occupying the minds of global CEOs. If they want to withstand the threat of disruption, chief executives need to incorporate political risk into their strategic decision making. Courtney Rickert McCaffrey is Global Geostrategy Insights Leader over at EY, and she joins us here in studio, too, to discuss. Great to see you here, Courtney. Let's talk about that here, because geopolitics, probably even more so than the last election, is certainly front and center, not only for CEOs, but quite frankly for a lot of regular folks on the ground as well. What is it specifically, though, within that geopolitical realm the CEOs are focused on?
Yeah. Well, there's a lot, to be sure. I think a few of the main questions that we get asked a lot about from CEOs and board members and other executives is around supply chain dynamics. So supply chain diversification, sort of thinking through the ramifications of that and how geopolitics plays a really big role in those strategic decisions right now. Of course, a big part of that is dynamics between China and the U.S., the EU and China, kind of that trilateral relationship there is really on the minds of a lot of CEOs in terms of how they're thinking about their global footprints, their global strategies, and their supply chains.
What can they do, though? Because this is effectively out of their control. Obviously, this is an electoral decision, and they're going to have to live with it no matter who ends up in office here. Do they start to make changes now in anticipation of what's happened, or do they wait until the election, maybe even wait until you get an inauguration in a cabinet and the other sort of administrators in place to react to whatever the new world order is going to be?
Yeah. Well, we're certainly seeing a little bit of all of the above. I mean, it really depends on the company's footprint, their sector, their risk tolerance. So different CEOs approach this differently. What we are seeing a lot of CEOs do, though, is use scenario analysis to try to plan ahead. Some of them are sort of gaming out those scenarios, seeing that there are some bets they could make now, some moves they could make now that would position them well no matter who wins the election. But others are maybe holding their ground a little bit to see how things play out. But overall, we are seeing, I think 98% of CEOs tell us that they are making strategic changes in response to the geopolitical environment.
Is every industry affected in the same way? And by that, I mean, technology companies obviously have a lot to contend with given all the different government responses and punitive actions they're taking. Consumer-facing companies need to deal with perhaps boycotts of certain kinds of products. But how are they, I guess, responding to this particular situations on the ground versus what they're hearing, in terms of what could happen?
Yeah, there's absolutely differences by sector. I think no matter what sector a company's in, they do feel geopolitics in some ways. But what we've seen in the past few years is that governments are really targeting their policy actions, both the carrots and the sticks, at what they consider to be strategic sectors for the national economies, for their sort of geopolitical competitiveness going forward. So certainly technology tops the list there. We're also seeing increasing policy actions around electric vehicles and sort of that entire supply chain. And certainly we're seeing some more activity in the biotech space as well.
How does this impact companies' abilities to grow through expansion, through buying other companies or buying maybe their supplier, or just getting more of a foothold through M&A?
Mm-hmm. Yeah, well, it's interesting that you asked that, because what we've seen is that the policies that governments are using do target investments in a lot of cases. And so what we're seeing is that cross-border mergers and acquisitions are sort of a lower share of the overall M&A market compared to the past. And what we're seeing is that there are more opportunities for M&A cross-border between geopolitical friendly countries, essentially, whereas between rivals, those opportunities are going down. So I think the opportunities still exist. It's just they're shifting in response to the geopolitical environment.
I know this is sort of more of a longer term question, but does this change the complexion of like who ends up becoming a CEO? The idea that boards now have to maybe consider a skill set that maybe CEOs that maybe have been there for a while and didn't have to confront these issues that maybe they're not prepared for. So when they start talking about new CEOs coming in, do you need somebody who's maybe cut from that cloth of, I don't know, maybe being a diplomat or at least being able to, as you say, sort of run a scenario analysis and figure out all the things going on?
Yeah, well, I would certainly agree with that statement. Yes, I think that, the skill sets of CEOs, what's needed in the business environment does change sort of from year to year, from decade to decade. And what we're seeing right now is certainly an ability to understand the geopolitical environment, to really task your executive team with understanding how it affects your company in particular, and then being able to incorporate that intelligence into how decisions are made is a really key skill set.
What kind of time frame are these CEOs thinking of when they're looking at decisions that they can make based on the shifting geopolitical landscape? Because, I mean, a presidential term is 4 years, and we seem to swing wildly from one administration to the next.
That's certainly been true in the United States. I mean, I would broaden it a little bit. This has been the year of the global election super cycle. So the U.S. is just one of many elections that's happened this year, affecting, I think, about 60% of global GDP, essentially, has gone to the polls this year. So what we're seeing is, CEOs do have, short-term agendas, and then they're trying to look out as far as they can, maybe 2, 3, 4 years. Much beyond that, it does get very hard to forecast where the world is heading.
Courtney Rickert McCaffrey, Global Geostrategy Insights Leader at EY. Thank you so much.
Thank you.
How much do you think geopolitics is going to come up in tonight's debate?
I don't know. I have pretty low expectations for this debate, for obvious reasons here. I mean, I have no doubt the moderators will ask about that stuff, whether they actually get responses out of them that are actually, substantive. That remains to be seen.
Yeah, no, that's a really good point. I mean, on certain things.
So what bar are you going to watch this?
I'm not going to a bar.
No, you're just going to sit on your couch and watch this?
Yeah, maybe look through, my hands at different points.
Maybe just put on some 3D glasses and see how that goes.
There you go. In terms of how markets closed on the day, there's a lot of course, anticipation before tomorrow's CPI report, which, when it comes down to it, is it going to answer the question of whether the Fed's going to cut by 25 basis points or 50 basis points? Probably not.
No, probably not, of course. But as you know, the market obsesses over these things, and maybe that gives them, maybe more comfort that the Fed will do what most people think it's already going to do, I guess, depending on what that number is tomorrow here. But again, it gets to this idea that you have the markets on edge. It's really not just about that report, but it's about this commentary we got out of the bank executives today, obviously the debate tonight, what the Fed does next week, and then we got to head into another earnings season. So if you're an investor here, this is not the sort of just throw a dart at the board kind of market that we had back in 2023 and the start of 2024.
Yeah, even with green numbers across the board there, you can see for the NASDAQ and S&P 500, September kind of living up to its reputation as a volatile month for stocks. This is The Close on Bloomberg. Investors on edge waiting for tomorrow's CPI report due out at 8:30 a.m. They're looking for more clues about how the Fed proceeds with its rate cut in later September. Joining us now for more on this is Stuart Paul of Bloomberg Economics. And of course, it'll be next Wednesday on the 18th when the Fed does make its decision. Investors are comfortable with this narrative that inflation has moderated, approaching that 2% target. It's no longer the risk it once was. Do you see any reason for tomorrow's print to surprise anyone or to stray from that narrative?
Our best estimate right now for headline CPI is 0.15% month on month. It's that knife edge estimate when the BLS does its rounding. We think it's going to round up to 0.2%, consistent with what we've seen over the past few months. So we don't think that there's going to be that major upside surprise that would knock the Fed off a cutting track. I think, if anything, we could see a modest downside surprise in headline inflation on a monthly basis, but still it looks like the annual measure of core CPI is stalling out. Our best estimate puts it staying at 3.2% year over year, and we are seeing that stalling out of core PCE. It's going to be a long last mile.
It's a long last mile. What's brought us to that long last mile? I mean, I know we can sort of point to, obviously, the Fed and sort of what it did to try to tamp inflation down, but obviously there was a lot more to it than that.
So there was the alleviation of supply chain backlogs and other sort of supply chain snarls that helped contribute to that disinflation. So we now have actual deflation in goods once again. That's the sort of thing that we've experienced for almost a decade before the pandemic. We've seen a lot of disinflation in shelter. But at this point, the disinflation that we're seeing in shelter is very slow. And we are getting some knock-on effects from past inflation. So auto price insurance, home insurance, those are all the things that are supporting inflation that are making for, again, that long last mile. It's going to be a bit sticky getting to that 2% inflation.
Yeah, once the insurance companies tack on those extra premiums, they're not going to take it away. So CPI is tomorrow, then PPI is on Wednesday, but the Fed really pays attention to core PCE. Will we get enough of a read from CPI to kind of understand what core PCE will look like, or that'll only come after PPI?
We're going to get most of the components from CPI. Some of the big swing factors, especially for super core PCE, that's core services PCE excluding shelter, some of those major swing factors come from PPI. One of the most important is financial services, particularly portfolio management services. And part of the way that that's calculated comes from, there's a long lag to it. It's basically a 3 to 6 month moving average that feeds in from PPI and then into PCE. And because it moves so slowly, the equity price momentum that we saw through the early part of the summer is still going to be feeding into that component. So that's going to be undergirding that super core PCE reading that matters most for the Fed.
When we talk about the overall health, though, of the economy, there was a lot of hay made today about some of the commentary we got out of this Barclays conference. A lot of banking executives talking about various things, some of it related to the drop in interest rates. But you had comments out of Ally Financial talking about a deterioration in auto loans, as well as a few other folks that basically seem to suggest that you are dealing with a consumer that is a little bit not just tapped out, but now really falling behind or potentially falling behind on payments. How much of that has to factor into the Fed's decision making next week, or at least the discussion that they have in that 2-day meeting?
I think that it goes into the full scope of everything that they're considering. We're definitely seeing more bankruptcy filings, personal and corporate bankruptcy filings. We're seeing more delinquencies on all consumer loans, including auto loans and unsecured loans like on credit cards. So I think that when the Fed is considering the health of the consumer, they're not just thinking that everything is a party and consumers are spending frivolously with a 2.9% savings rate, which is exceptionally low. They're seeing that consumers are tapped out. They're trying to make ends meet. They're trying to make ends meet on credit. And that also means that some of their payments on bills are falling behind.
All right, Stuart Paul, one of the best in the business here at Bloomberg Economics. A closer look at the CPI report scheduled for 8:30 a.m. Washington time tomorrow. Team Surveillance will have full coverage of that. And if you are looking for those inflationary or deflationary trends here, maybe look at your grocery bill, Scarlett. Consumers are getting some relief there. New data showing that online grocery prices are plunging by the most on record in August. And I was kind of fascinated by this, mainly because of why they're separating out the online stuff from in-store. And I don't know, is this a true deflationary cycle, or is this more just the fact that we've all just gone back to the stores after, relying on Instacart and everything else during the pandemic?
Exactly. I'm not sure how many people buy most of their groceries online. I mean, most people aren't even at home to accept their groceries at this point. They'd be, sitting under the sun. Someone might take it, or it might be rained upon. So, I mean, when was the last time you bought all your groceries online, or at least the majority of it?
Well, my wife doesn't allow that. She does. Yeah, she's totally against all that stuff.
She has to pick out her produce.
Yeah, she wants to go to the store and touch the produce and look at the meat and all that stuff, which I get. And maybe this gets to the point too is, are you seeing this just in those online things? I mean, is that just like fees coming down?
I feel like it's easier to track.
Or is that the actual price of like eggs going down versus what I'm going to see in the store?
No, that's really true. And also, let's not forget, anything that's online is subject to dynamic pricing. So how stable are those prices? They could change minute by minute. They can change based on, whether you put something in your shopping cart and then you left it for 10 minutes and you came back.
Yeah, complex economy, but at least one segment of it here offering some relief for consumers. A lot going on this week, a lot going on over the next 24 hours. We're going to set you up for what to watch when we come back. This is The Close on Bloomberg. All right, let's set you up for what markets are going to have their eyes on over the next 24 hours. And of course, we have to start with tonight. the first and maybe potentially the only presidential debate between Kamala Harris and Donald Trump.
And as you pointed out earlier, the rules are going to be the same as Trump's debate with Biden in that there's no live audience. The microphones will be muted. It'll be an hour and a half long. I think I'm going to wait for the highlights the next day.
Yeah, it'll be interesting, too. I mean, so much has changed, of course, since we've kind of forget there was a presidential debate. It was between Biden and Trump, of course. That was back on June 27th. And then, of course, you had that effectively an attempted assassination on Trump in mid-July, and then Biden dropping out on July 21st. Kamala Harris, now the Democratic nominee. Full coverage right here on Bloomberg, starting at 8 p.m. Eastern. Of course, the actual debate itself starts at 9 p.m. Meanwhile, we move forward here. We do get some economic data points at about 7 a.m. tomorrow.
Yeah, the really, really important one is at 7 a.m. MBA mortgage applications.
Yeah, we also get at 8:30 a.m. Eastern time. We get those monthly U.S. CPI numbers that we were just talking about with Stuart Paul.
And at 10:20 a.m., Jensen Huang, the CEO of NVIDIA, will be speaking at a Goldman Sachs tech conference with David Solomon in Chicago. David Solomon, the CEO of Goldman. That'll be fascinating, especially as people are really waiting to hear any kind of update from Jensen Huang that may differ from what he said at the earnings call.
Yeah, a lot going on there as well. And in the world of entertainment, MTV's VMAs also tomorrow night. That's at 8 p.m. hosted by Megan Thee Stallion. Thanks for joining us here on The Close. We'll be back tomorrow here for all of your markets coverage. For all your politics coverage, stick around. A lot going on tonight. Balance of Power team, they're on deck right at the top of the hour, right here on Bloomberg.